Hi guys, welcome to today's episode. It is my great pleasure to have Giri Addanki on today's episode. Giri is the founder and CEO of Acorn Finance, an embedded lending marketplace for home improvement financing, driving better outcomes for borrowers, lenders, contractors, and software vendors. Prior to Acorn, Giri was the founder of Mindful Meal, a corporate wellness SaaS platform that helps corporations and insurance companies lower healthcare costs by getting busy employees and their families to eat healthier and save time and money. Giri has previously spent years in strategy, marketing, and product development at Citi, Barclays, and Capital One. He started his career at Ernst & Young in accounting and audit. Thank you for joining us today, Giri. It's great to have you.
Thank you so much for having me. I'm really excited. I appreciate the time.
Awesome. So I want to kick off this conversation by spending the first few minutes talking about you, actually. I think it is fair to say that the entrepreneurial bug really bit in 2015 after you had spent years at large financial and consulting institutions. Walk us through how you made that transition and what eventually led you to founding Acorn Finance.
My prior startup, Mindful Meal, was really born as a side gig while I was working for some of the large institutions. And the whole idea behind Mindful Meal was to really leverage analytics, which I led in these companies, and really focus on the food problem. It was a great product, but I was a first-time founder. I did a few things right, and I did a ton of things wrong. And the product just, didn't gain adequate traction. And in the meanwhile, after a couple of years, I just stumbled upon this huge opportunity in the home improvement space that had my name written on it. So I jumped on the opportunity. So here is the backstory. So the problem that we solve today is that if you, let's say, have a heater that breaks down, a contractor comes to your house, you expect it to be, $500 for it to get fixed, but the contractor's like, listen, Rashvina, you have to replace this. It's $50,000. And then you get an estimate. Historically, you've always had one lender to a point of sale estimate. And then what happens there is you are, stuck with the way the lenders make decisions. You're stuck with the credit cycles, et cetera. And we saw this huge opportunity where why have one lender? Instead have multiple lenders that can really compete for that, right? So that was the start of Acorn. The use case, as I said, when a contractor sends you that estimate, you click on that estimate and fill out a short form. It takes about a minute. And then when you submit it, we leverage APIs with large financial institutions like SoFi, Upgrade, Truist, et cetera, and then come back with offers that are pre-qualified. So you don't have any impact to your credit score. And we'll list all those offers, and we'll list them by the lowest monthly payment. So you can click the offer, you can get the money, and get your project done. So the contractor wins because he or she closes the deal. You get your project done by just quickly shopping around. And the lender wins because the lender has now gotten a customer who typically is a homeowner trying to invest in their home. So they have much better credit at the time of, point of need. So it's really a three-sided marketplace with lenders, with contractors, and then homeowners.
Great. I think this is a great story of really identifying a very strong inefficiency in a system, in a subsector even. And it also made me think of all the gig platforms that are also trying to solve for this inefficiency between contractors, homeowners, but in different spaces. So it's great to hear the backstory behind Acorn. So just shifting gears a little bit here, the theme of today's episode is navigating financial storms. And when we talked 2 days ago, I remember you saying the last 3 years have been a double whammy. And boy, it has been. You raised a funding round right before COVID. Can you walk us through some of the critical decisions you had to make with the business, the team, the product during the COVID period, and how you navigated it as a founder and CEO?
Yeah. So yeah, we closed around just before COVID, in December 2019, and so in the home improvement space, um, uh, early winter months and spring months are trade show months. So you'll see a ton of trade shows. So we got a brand new booth. We were getting ready to, actually, we had planned and we went to a bunch of these trade shows, and our goal was to obviously scale up distribution, sign up some partners on the contractor side. We attended a couple of trade shows, and then the world shut down. So we really faced three problems. Number one is we typically focus on working with large SaaS providers who consolidate and who have consolidated contractors. So instead of going one contractor at a time. So on that side, one of our biggest deal just paused. And so because, the world was just recalibrating. On the lender side of the equation, again, our plans and forecasts went out the window, because typically what happens is you see that when there is some kind of an exogenous event like this, lenders immediately tighten. It was not as bad as the financial crisis, but they just tighten. They tighten their underwriting, and they slow down a little bit as they're trying to figure out, what's the new normal. And then finally, just, as overall, just the whole industry and the news was just, doom and gloom, right? So as I think back as to, how we navigated it, I really can categorize our actions into, four buckets, and I want to call it 4 Cs. So number one is collaboration. Number two is control. Number three is communication. And number four is conviction. So to expand upon it, so collaboration. So as soon as COVID hit, Mike from Vestigo, he was on the board, Mike Nugent, and we had another board member as well from Metaprop. We convened, weekly meetings, and we want to kind of understand how to, navigate the storm. And what I realized was when things get choppy, you really want to lean on your investors, because they have a very good understanding of the outside world, right? They're talking to hundreds of companies, both their portfolio companies as well as, new companies that they are constantly looking at. So they have a much wider perspective. And we as founders and as management team have a much deeper perspective. So we understand how the business and how the drivers of the business are impacted. So it was great. We came together once a week and truly collaborated. On the control side, as it's anxious, right? You are trying to figure out what do we do with our plans. So I remember I just created a slide which said things in our control, right? We had what are we going to do over the next quarter? Really, let's focus on what are some of the things that we can implement, both on the technology side and product side, as well as on the sales side. What are some of the pieces that we already have, and let's work on those. And then number two is how do we build a robust pipeline of both lenders as well as contractor and point of sale providers. So those we could control. We could control how we planned on a weekly and a monthly basis. And then I had this other bucket which said, what can't we control? And I literally said everything else. So we just, so I used to look at that every day and say,
I
okay,
think this is such a great slide to have for life in general. But yeah, just that's great.
Yeah, well, I'm like, when in doubt, just look at number one. So, and the third thing was communication. So the weekly meetings that we had it for about 2 months. We had, not just the board, but also everybody on the management team. And these were actually, I know a couple of other founders I talked to, and they were like, wow, you have weekly meetings. And to us, it was not an overhead. It was more of a work session. These were not meetings. We did prepare for those meetings. And that really helped us, hyper focus and clearly communicate across the board, right? And, we worked as both our investors as well as the team as one team. And we said, what can we strip off and just really focus on what would get us to that next milestone. And then finally, the fourth one is conviction. So this is a very interesting story we have where when COVID hit, we had this opportunity to use our home improvement platform and our lenders to try to solve a problem in the hair salon space. So help hair salon customers get, PPP loans and get, other personal loans and business loans. And we were so excited. We went to the board, I think it was like week 3, and said, hey, listen, we have this awesome revenue opportunity. And to our surprise, I think, Mike and Zach were like, what happened to your conviction? Home improvement, you just raised capital. So no, we have we still have our conviction. We were just trying to solve for revenue. And they were like, no, this is the time when you hunker down and you just focus on, really taking advantage of building the product and staying the course. And that was a very important lesson for us. When you have choppy waters, and let's say you're riding a boat, you might go a little bit, veer off to the left a little bit or right a little bit, but your goal is to, if your goal is to go to Japan, you don't end up in Australia, right? You need to stay focused.
You can't go that far off on the trajectory.
Exactly. So those are the 4 things I think, and then we really focused in in that first quarter, and then we had a little bit of luck and tailwind that hit us, and that was after COVID. Home improvement just took off, right? People got some PPP money, they got some unemployment, and they were all stuck at home. What do? Average vacation in the US is $1,200, which you are not taking anymore. You're not going to Disneyland, and you didn't go to restaurants, so you were stuck at home, and people just started doing home improvement projects, and it just so the demand came, and what finally our focus was, we had a biggest weakness. The weakness then was we didn't have the right number of lenders, and that's where we went and just doubled and tripled down on our lender pipeline. And we went from, so every time somebody applied for a loan on our platform, only 41% of the time we were able to provide offers. After about a year, it went to 81%. So that was the biggest lesson where we said, let's, coming back to conviction, let's focus on, what we set out to do and do it well.
Yeah, that's amazing. The market came back, and what you said was really interesting. And I was thinking back to, you're right. I mean, during COVID, you're stuck at home, and based on my experience, the top 3 things I saw people were getting busy with was cooking, home improvement, and working out. So I'm glad that it worked out that way. And I think what you said around communication is also very important. I think in times of crisis like this, if you don't properly communicate with, employees, investors, the market, if you're a public company, it does you a disservice, because the perception usually is negative. So unless you appease the view and you keep in touch with the important stakeholders, it is also a great way to just manage, the business. So I think that's great that you managed to do that. I love the 4 C's. And, just when we thought we had to overcome a major storm, another one hit us. And I'm talking, of course, about the VC and startup market recalibration, and more recently, Silicon Valley Bank's fall. What are some of the key learnings and or mistakes you made during COVID? And you talked about some of that strategy that translated to better management during this period.
Yeah. So once again, the timing was a little bit off, but we did raise again our Series A and again December of 2021. And we scaled up from about 10-ish employees and contractors to about 40. So we had we have planned to, fill our management team. We are also planned to really fill all the functions. We did that fairly quickly. And then our revenue grew from, from the end of December of 2019 to kind of the middle of 2020. I'm sorry. So this Series A we raised in 2021. So 2021 December to middle of 2022, which is last year. Our revenue grew 3x, which was great. And then couple things happened, right? One is the Fed started rapidly raising interest rates. We've never seen, just in the span of 6 months, the interest rates go up by about 5 percentage points. And again, same thing that happened as the COVID time. All of a sudden, what happens with lenders is, right, when you have virtually 0% rates, the products out there are very competitive. That helped us actually grow our revenue, right? And we did some good partnerships, but then all of a sudden, loans became expensive. So the demand went down a little bit as the monthly payments went higher. And then lenders again start to calibrate. They are like, well, we don't know whether we want to, do risky loans. So if they were doing, let's say, 660 FICO and above, they'd probably say you want to do 700 and above, right? So they start, cutting down on that as well. So again, we saw our approval rates start to go down, and just like COVID, we knew that it's going to, come back up. So we did get, our revenue grew, as I said, 3x, but then we had a huge decline in the fourth quarter. And part of it was, a couple of lenders shut down, and, they were struggling with capital. And part of it was there was a, technology glitch with one of the lenders, et cetera. So as we started the year, this year, we went back to our, really 4 C's. Number one is we said, let's, again, sit with the investors. We created a kind of a detailed strategy of what we're going to do this quarter. And it was, there were 2 kind of broad initiatives. One was revenue optimization. So we're going to continue, and we're going to really try to see where can we, but, obviously keeping our path and course, where can we pull some levers and partner and increase revenue in the quarter. So this is like immediate revenue optimization. And the second thing was growth strategies. All right, we're going to continue to have our growth agenda, and how do we, what are the 1 or 2 items that are critical for that we're going to really focus on and, strip everything away. So we put it in a deck. And once again, we shared that with our investors on a Monday. And then, coming back to the second point, which is communication, we immediately shared that with the whole team the next day. And then after that, we did a planning session, which we typically do, where we plan for the quarter. What are we going to do in, Jan, Feb, and March, and just literally break it down by weeks. And so really from our, associates to the management team to the investors, our strategy for 3 months is really in everybody's bones. It's crystal clear, right? So that was the second piece. The third piece, when, control, once again, we knew that these are the pieces that we can currently control. We knew that the lenders are going to recalibrate and then come back up. Really, our strategy was to, how do we increase the number of lenders so that we have a broader base? So we actually did a couple of partnerships that would enhance and increase the number of lenders we have versus us taking a slower approach of onboarding lenders. So again, we focus on that. And finally, I think when it comes to conviction, I think this is something that we learned before and something that we ask ourselves. Yes, we have a quarterly plan focused on revenue, et cetera, but our charter is to build $100 million company, right? And in terms of revenue, that's our next big milestone. What are we on path to do that, right? And what is so both in terms of growth and revenue optimization, is it leading us to that ultimate objective and goal? So I think that's, again, as we created this deck, we just make sure that we articulated all of those pieces.
So a really bad event overall and a lot of repercussions, but also a good testing ground for your 4Cs, which I'm sure as, early stage startup founder, you do not imagine having to deal with two major crises so early on. So that's really great to hear how some of that strategy helped you this time. So we've talked about two major financial setbacks. So I really want to ask, how should founders think about financial setbacks going forward? What should be the top priorities?
Yeah, I think a couple things. Number one is, I think there's a ton of advice out there, right? You get a lot of advice from investors. You have blog posts, and you have podcasts, etc., giving you advice, right? So I think it's really important to really parse that out, right? And to me, I think one size doesn't fit all, and then also the advice varies from stage to stage. You need to realize what stage you're at, right? So in my mind, seed stage is about just viability. Series A is about creating repeatability, and Series B and beyond is about scalability, right? So for us, we have a product market fit, and now we're focused on creating repeatability. So we have this core team, and we have a bunch of experiments, right? So I would say during times like this, what you want to do is you would just want to make sure you manage your experiments better, right? You just instead of doing 10, you want to be more efficient and focused, and kind of do maybe 4 or 5 that add the most amount of value. And then following that, as we really shift from growth at all costs to sustainable growth, again, to me, the focus is around, okay, what experiments are really needed, and I'm talking about Series A stage, to really create that repeatability, meaning to get a repeatable unit economics model, and just focus on those experiments, and just get your whole army just like really hyper focused on that, but that would help kind of continue to build out what you need for the next stages.
This is some great advice, and I'm sure if there are any founders listening, they really appreciate it. The lessons on crisis management. Giri, this has been a great conversation. I do want to end with a question on, I guess, hopes and aspirations. So by asking you, what are you looking forward to the most as the CEO of Acorn Finance, whether that's within the business, the home improvement market, or anything else for, let's say, the next 12 months?
Yeah, so really 3 things. I think on the home improvement side, home improvement last year in 2022 grew by 15% to $567 billion. I mean, it's a huge industry, right? And this year, it's not expected to grow as much. It's actually expected to grow by about 2%, but still $567 billion, right? So wow. is the starting point. So that's number one. I think what we're going to see this year is discretionary spend is going to come down. So if you want to $40,000 swimming pool, you probably will get maybe a smaller pool because the inflation is still prevalent. Interest rates are higher, so it will cost you more, and the housing prices are going down a little bit, so you have a sense of less equity in the house. But non-discretionary stuff like roofs, windows, HVACs, they're actually going to grow because people are going to stay in their homes because they've locked in to much lower interest rates. They don't want to now move from a 2% plus interest rate to like a 7% plus interest rate. So homes are aging, so they'll continue to kind of invest in their homes, especially when things break. You have to get them fixed. And then finally, we're also seeing with the Infrastructure Investment and Jobs Act, and the Inflation Reduction Act. There's a lot of incentives for retrofitting homes with energy efficiency, and climate friendly things. So I think we're going to see a lot of kind of investment in that. So home improvement is going to be resilient, and is going to continue to be grow at a decent pace. The second thing is fintech, and we are at the cusp of prop tech and fintech. I would actually echo a recent podcast that I heard where Nigel Morris, who is from QED, he was talking about how fintech is not in its eighth inning, but in its second inning, right? The NPS scores of large banks are still in their 20s, and fintechs are in their 80s.
Yeah.
And what fintechs do really well is really focus on the end customer, and build solutions that the end customers need, right? Our goal is to 10x the experience and products that they are using. Whereas large banks, they focus on regulation first and build products around the regulatory, build products to make them regulatory friendly, right? So that's where fintech is a tremendous opportunity, and it's still super exciting. And also we're seeing a lot of banks starting to build APIs, et cetera, and things are moving faster. You're seeing ACH starting to move really fast. So both payments and lending, there's a ton of innovation that's happening. And then finally, the stage that we're in, as I said earlier, I always think about our focus is, yes, we are creating and we are, solidifying our repeatability. And our next stage is to truly scale. And, as we, when I think about growth, I think about two pieces, right? There is experimentation. And I think you want to be a little bit more measured in experiments, as I said earlier. But when it comes to growth, you want to be extremely aggressive, right? We are in the business of taking risk, and we want to grow as fast as possible. So one of the things we are working on this year is, what are the pieces of business that are ready to scale, and then we want to pour as much gasoline as possible on those.
Great. That's some great things to look forward to. Really interesting on the point of fintech. And I really echo this. People talk about how fintech as, a category has existed for years now. But even today, like you said, there's some areas that are still so behind, whether that's customer service, automation in, compliance, credit underwriting. And it's always surprising to me, but I think it is the dynamic of, startups versus legacy institutions and trying to bridge that gap. And, I had a friend, he's a founder, and was opening an account after SVB at another bank, and, a bigger bank that has been around for longer, and it was taking forever. And then that reminds you of why SVB existed in the first place, and things went really poorly. There's a whole different conversation there, but it really brings out a lot of the inefficiencies that fintech is trying to solve. So thank you for sharing that. Giri, this has been such a great conversation. Thank you for joining us today. I'm sure our listeners will really appreciate this.
Thank you, Rashvina. Really appreciate you having me, and have a good evening.